Hello, I'm Amber Robinson, and we'll be discussing today Chapter 6, specifically 6 8 through 6 18. The topics that we are going to discuss today are ordinary and necessary trade of business expenses, depreciation, listed property, luxury and leased vehicles, travel and transportation, and keeping good accounting records. So let's dive into it. So what are ordinary and necessary trade of business expenses? There are three specific criteria for expenses to be deductible. First and foremost, they have to be ordinary. And according to the book, or for an expense to be ordinary, it must be usual to the taxpayer's business. Okay, so on an everyday basis, when a person is conducting their business, it has to be usual to the everyday practices of business. Necessary is an expense that is appropriate and helpful opposed to an essential one. So it helps the business out and it's appropriate for everyday functions of the business. Now, at some point, reasonable was also added by the courts beyond the scope of the first two. Reasonableness has to have the component of the first two in it, but reasonable in the amount in relation to the business purpose. So it can't be where you go off on a tangent and spend this extraordinary amount of money and think that you can deduct that expense. Here's a quick example of a deduction that's not being reasonable. So this is similar to something that happened in my real life, as I was an insurance agent at some point, a broker. And so Patty is an insurance agency owner who is very successful and is in the 35% marginal tax bracket. She employs her son, Justin, as a telemarketer for leads, paying him $25 an hour to reduce her taxable income. Under normal circumstances, Patty would pay someone else $10 an hour. So this is where this comes into play. That extra $15 an hour would actually be disallowed because it's not reasonable. There are other forbidden deductibles which, in light of what goes on in the world, we really do need to touch upon these. For instance, illegal bribes, kickbacks, and other payments. No hush money. Payments for certain lobbying and political expenses, as well as payments for fines and penalties. So let's dive into depreciation here. Okay. And what I found interesting in the process of dealing with depreciation was that depreciation in the sense of doing taxes is not necessarily the same as if you were to do depreciation for cost accounting. I thought that when I first started this chapter, I was like, oh, this is easy. I've seen depreciation before, and I'm just going to attack it the way that I had been accustomed to attacking it. Well, not necessarily. So according to the IRS, depreciation is an expense allowance for the wear and loss of usefulness of a business asset. It's also known as cost recovery. Depreciation provides large cash flow savings for a tax reduction and can also be used of tangible business assets except for land, which I can understand that because land in a sense should appreciate in value and should not depreciate. Typically, you would find this information on Form 4562 of the IRS. Depreciation can also be used for property held in the production of business or income. It cannot be used for inventory or investment property. And after January 1st, 1987, it indicates the modified accelerated cost recovery system that is used to calculate depreciation. So diving deep into depreciation, there are 4 components of depreciation in which we'll go over in specific detail. The first one is basis, which is typically the cost of the asset. And depending upon how the asset is acquired, will determine what the basis of the asset is. There are also depreciation periods, which is also known as the class lives of assets, as well as the depreciation convention, which typically there are a total of 3 of them, as well as depreciation methods. Right here we have 200%, 150%, declining balance, and straight line. So let's talk about the depreciable basis and how the business asset was acquired along with the basis. So if the asset was purchased, then basically the depreciable basis is the actual cost of the asset. Now, if it started off as a personal piece of property and was converted from purchase for personal use to business use, it is then the lower cost or the fair market value at the conversion date. For instance, I use my computer quite a lot for personal use. I've decided maybe about 2 years ago to actually utilize my computer for business use, in which I do readings and all things spiritual. At the time that I purchased my computer, it was $2,500. Now it is valued at about $1,000. So that would be my fair market conversion at that date that I started to use my computer for business. So with the non-taxable exchange, the cost of the asset is less the deferred gain of the old asset. And if the property was inherited, then the depreciable basis or cost would be the fair market value at the descendant's death. For instance, my uncle died and he left me a ton of comic books. And at that point, whatever the fair market value of those comic books were at his death is what I would utilize. So let's dive into the depreciation periods. I like to say MACRs. I don't know if it's appropriate to say so. So for the recovery period of 3 years, and this is taken from the textbook, these are typical assets included in recovery periods of that time. Racehorses less than 2 years old and certain specialized industry tools for 5 years. Autos and light trucks, computers, and peripheral equipment. 7 years, furniture and fixture, as well as equipment. The 10-year mark indicates barge vessels, tug plants that bear fruit or bear nuts. For 15-year recovery period, we're looking at telephone distribution plants, wastewater plants. I don't think I got the 20-year mark, but you can look in the book and see what it specifies. The 27.5 years farm buildings and 30.5 years is residential property with acquisition dates between January 1st, 1987 and May 13th, 1993. And then we have the 39-year recovery period that indicates non-residential property gained after May 13th, 1993. So the depreciation conventions are half year, mid-quarter, and mid-month. Let's start with the lower of the 3. For us to be able to use the mid-month convention, the mid-month convention looks at this for non-residential real property, residential rental property, and any railroad grading or tunnel board. So under this convention, you'll treat all property placed in service or disposed of during the month as placed in service or disposed of at the time of the midpoint of the month. This means that 1/2 month of depreciation is allowed for that month. The property is placed in service or disposed of. Your use of the mid-month convention is indicated by MM already shown under column E in part 3 of Form 4562. For the mid-quarter convention, one would typically use this convention if the mid-month convention does not apply, and the total depreciable basis of MACRA's property you would place in service during the last 3 months of the tax year. And this is excluding non-residential real property, residential rental property, and any railroad grading or tunnel board, property placed in service and disposed of in the same year, and property that's being depreciated under a method other than MACRA's. And it's more than 40% of the total depreciable basis of all MACRA's property you place in service during the entire year. So under this convention, you treat all property placed in service or disposed of during any quarter of the tax year as placed in service or disposed of a midpoint of that quarter. This means that for a 12-month tax year, 1.5 months of depreciation is allowed for the quarter of the property that the property is placed in service and disposed of. Okay, so it gives you half of that. And there are examples in the book that would talk specifically to these. So for the half-year convention, this convention would be used if neither the mid-quarter convention or the mid-month convention applies. Under this convention, you would treat all property placed in service or disposed of during a tax year as it's placed in service or disposed of at the midpoint of the year. This means that for a 12-month tax year, only 1/2 year of depreciation is allowed for the year that the property is placed in service or disposed of. All right, so we're going to go into depreciation methods. But before we do, just to touch upon the conventions, you can actually find the conventions and see that they're built into depreciation tables issued by the IRS. And you can also see these in the appendix of Chapter 6. Okay? So it's always important to really determine the convention to use when calculating the depreciable expense. Okay. So with the depreciation methods, there's only 3 depreciation methods are allowed for MACRA's property purchased on or after January 1st of 1987, which is a 200% declining balance switching to straight line. This is used for 3, 5, 7, and 10-year MACRA's property purchased after January 1st, 1987. The next one is 150% declining balance switching to straight line. And then there's straight line depreciation, no frills. Okay? Now let's go back to the 200% declining balance method. Okay? So if you have a 15-year property and a 20-year property, 150% declining balance is used. And then after that, the depreciation switches to straight line in the tax year, in which the straight line yields a higher depreciation allowance. Now the straight line is required for all depreciable real property. In these cases, the salvage value is ignored for the tax purposes, and the taxpayer can actually make an irrevocable election to use a straight line for any of the classes. There is an opportunity to look at example 610 soon, where we can actually see how this works. Now, the 150% declining balance to straight line, like I mentioned before, that's used for 15 and 20-year Macris property. So according to the book, it shows that Samantha purchased equipment for $8,000, a work truck for $19,000, and an office building for $120,000. The depreciation calculation for each asset follows. As you can see with the equipment, it goes from 2023 to 2030. So that's indicated as a 7-year property. So that would actually be half year with the $8,000 depreciation basis. And then that declines. With the truck, we have the 5-year property. That would also be half year. $19,000 basis, and then it declines. The building is a 39-year property. This one uses mid-month for the $120,000 basis, and it goes from 2023 to 2061, and then at 2062, it levels out. Table 6.3 is a summary of Macris depreciation, where we go back to the 3-year racehorse option, and so it shows half year and mid-quarter can actually be used with a depreciable basis of 200%, double declining balance to straight line. The depreciation table that would be utilized for this concept is 6A-1. And we look at the 5-year cars, trucks, computers, also using the half-year mid-mark, and the 7-year furniture and equipment also using the half-year mid-mark with a 200% double declining balance to straight line. For real property, it would actually use mid-month, and that would be straight up straight line depreciation. This is in table 6A-6. And then we have 31.5-year non-residential, which also uses mid-month, table 6A-7, and 39-year non-residential, where the property was acquired after May 14th, 1993 to present. This also would use a convention of mid-month straight line depreciation for the method, and then to get more information about that would be to look at the depreciation table 6A-8. So I thought this was pretty interesting. IRS has rules and limitations in which they have special allowances. So this is the IRC Code 179 expense election. What is Section 179? Section 179 of the U.S. Internal Revenue Code is an immediate expense deduction that business owners can take for purposes of depreciable business equipment instead of capitalizing and depreciating the assets over a period of time. Section 179 deductions can be taken if the piece of equipment is purchased or financed at the full amount of the purchase price. Is eligible for the deduction. So from what I understand, that you don't necessarily have to wait until you finish paying for the piece of property. You can actually deduct it based on this section of the Internal Revenue Code. Why would someone use Section 179? Again, it's beneficial for small businesses to expense cost of assets in the year that it was purchased opposed to over time, which would pretty much allow for a bigger deductible or expense so that small businesses can have more liquidity. The property must be used in an active trade or business. Now, keep in mind, 179 cannot create an operating loss. And in order to be able to use Section 179, Property cannot be gained from gift or inheritance. At that point, the expense is limited to cash paid for the property if it's actually traded in. For example, and this is taken out of the book Example 6-11. So ABC Company purchased $1,190,000 of personal property in 2023. The company can elect to expense $1,160,000 under Section 179. Now the remaining $31,000 is depreciated using the regular MACRS rate. All right, so in 2023, we're going to talk about something that came up then, and it's called 80% bonus depreciation, okay, of 2023. So one can actually take an accelerated depreciation deduction equal to 80% of the basis of certain property, and that could be allowable. How one would consider taking this is that it has to be new or used property with the MACRS recovery period of less than 20 years. Also, property acquired and placed in service prior to December 31st, 2023. Now, starting in 2023, the bonus is phased down to 0% from 2024 through 2027, and it gives over 5 years. Example is Jack purchased a piece of new equipment, 7 years, MACRS, for $570,000 for his business on March 1st, my birthday, 2023. So under the 80% bonus depreciation, Jack is allowed to deduct $456,000 by using the 80% bonus depreciation. Now after that, Jack could consider using either Section 179 or the bonus. Okay? Now there's always a fear. And for business owners, there's a fear of losing revenue. And primarily from the use of accelerated depreciation methods on assets that's been both business and personal use. So one good thing about our country is that Congress established limitations and restrictions on listed property. Okay? So listed property, in order for it to be expensed, consists of the following: any passenger automobile, any other property used as means of transportation. Now, this doesn't include taxis or vehicles that are used for trade or business. Also, any property used for entertaining or amusement, including photographic, communication, and video equipment. Now, at some point, computers and peripheral equipment, they've been pretty much listed property. But the 2017 Tax Act removed these items from listed property classification. Listed property doesn't include the above items that are used exclusively for business at a regular business establishment. For the normal MACRS rules to apply, listed property has to be used predominantly for business, which means that it's used more than 50% for business. Now, if the taxpayer is an employee and it's not self-employed, the use of that asset is not a business asset, or you can't use it for business use unless it's both used for the employee's convenience and also required as a condition of employment. So this kind of goes into what some people actually would purchase in conjunction with their business. And usually As a sales rep, I can always think of when I was a W-2 employee. And one of the items that I would have to sometimes purchase was a cell phone. And the book speaks to an example of this. So, example 613 shows that Linda is a public relations officer for her local city government, and she purchased a separate cell phone to complete the work while she was traveling and working from home. So, her phone use is 70% business related, but her employer does not require the phone as a condition of employment, nor is it used for the employer's convenience. Because Linda is an employee and the cell phone does not meet the business use test, then she can't depreciate that asset. Okay? Now, this is a different one that we can take a look at, which is example 614 in the book. So Jack purchased a large screen for video conferences for $2,500 for use in his home office. And that screen is used 70% for his business and 30% for his children to play computer games. Because the screen is predominantly used for business and is a 5-year property, Macker's depreciation for the first year would be $350, seemingly $2,500 times 70% of business use times 20%. And the 20% comes from table 6A-1. But if the business were only to use 30%, then he would choose to elect to use the straight line depreciation, and that would be required. Oh, one of my favorite. Well, I'm not a car person, but that's my husband. So I found this to be very interesting. All right, so we're going to talk about luxury vehicle limitations. Okay. So, in addition to like the business use limitation, the amount of depreciation allowed for luxury vehicles are limited. Okay. When it comes down to luxury vehicles, there's a distinction where the vehicle has to be four-wheel vehicles made primarily for use on public streets, roads, and highways with a gross vehicle weight of less than 6,000 pounds. Now, light trucks do not have a separate limit. They had in the past, but they don't now. So the depreciable expense limits for luxury autos and light trucks placed in service in tax year of 2023 follows. For year one, the auto limit is $20,200. Year two in 2024, $19,500. Year three in 2025, $11,700. Year four in the preceding years, or succeeding years rather, it's $6,960. Now, these limits actually apply to both IRC Section 179, the 100% bonus, and regular Macker's depreciation. Okay? Now, if for some reason a 100% bonus was not taken, the limit for regular depreciation would revert to $12,200. And so the reason this came up was that prior to 2005, many taxpayers tried to circumvent the luxury auto rules by purchasing vehicles with the gross weight of more than 6,000 pounds. So if it was like a Humvee or a larger SUV, the taxpayer can use Section 179 or bonus depreciation to expense the entire purchase. There goes the fact that I could have gotten an Aston Martin and used that, right? So, for purchases after October 22nd, 2004, the 179 section deduction is limited to only $28,900 in 2023, with the inflation adjustments on these larger SUVs. So the regular Macker's depreciation is still unaffected by the luxury ceiling amounts, and keeping the purchase of these vehicles still relatively attractive in terms of depreciation. But the current bonus depreciation is not limited to $28,900. And with the 100% bonus, there's not a limitation from 2018 through 2023. Okay. There's example 6-18 to look at for further review if you want to understand this a little bit more in stature. Now, with lease vehicles, the IRS limits the lease deduction for lease vehicles, requiring taxpayers to include certain amounts of income to offset the lease deduction. The lease inclusion amount is based on the fair market value and the tax year that the lease began. The full lease payment is deducted if the auto is being used 100%, and the income inclusion reduces net deduction. I would probably use this in the case of my friend, because although he is a videographer at home for depositions, a court videographer, he does work on the side as an actor, and he will use his newly leased Tesla to go back and forth to these sets, these film sets. And so he's typically utilizing the car for business use as his current reason for working. He doesn't necessarily need to use that. I can see incorporating this for that particular purpose, just for a personal example. But because he received his Tesla on a lease in 2024, to the extent that if he were to take the deduction, it would be aligned with his taxable income, if I can understand that in that particular manner. Okay. Now, it's always very important, very, very important to maintain proper records. And according to IRS publication 946, they have a list of how this should be done. By using an accounting book, having a diary, making sure to maintain proper electronic and personal logs, always keeping a statement of expense, trip sheets, as well as similar records. And all of these expenses need to be shown as used in the records throughout the entire year. Now, it's so interesting because, like I mentioned before, I've sat down and I'm used to being a life insurance agent, and it's so interesting to sit down at the table with other agents that have to go to like these different conventions, different seminars, so to speak, and sometimes it would require for these individuals to go out of town. And I've heard and seen a lot of stuff, and the meals and the travel and expenses, it's always been told, oh, you can deduct this and you can deduct that. But I'm glad I'm taking this class because the transportation and travel piece spoke to me. Now, when it comes down to deducting expenses for transportation and travel, transportation is considered, according to the IRS, getting back and forth from one workplace to another. Okay? So it's not where it will be allowed if you're commuting from work. If I leave my house, if an agent leaves their house and they go to their office, you cannot deduct that. But if they leave their office and they have to go to a client's house, or leave their office and go to the seminar that's local, then that's an expense that can be deducted. Okay? Now, when it comes down to what can be deducted as an expense for travel, the IRS indicates business travel that has to be away from the home that requires an overnight stay. Okay? And typically, I look at these as not have been reimbursed in any way, shape, or form. Okay? And we already talked about the local transportation expenses. All right. So, in conclusion, there are many moving components to depreciation. Okay. As you can see with MACRS, and as you can see with the time periods, the conventions, straight line depreciation, the types of property that can actually be depreciable, what is considered depreciable, ordinary and necessary expenses. But it's not the same as it is for regular cost accounting. When it comes down to ordinary and necessary expenses as well as reasonable ones, don't do anything illegal. Period, point blank. Make sure that it is legal. Because if it is illegal in nature, then that trumps what's necessary, what's reasonable, and what's ordinary. Okay? I do believe that understanding these concepts will assist in understanding more of what can be done for the clients in the most efficient manner with the highest level of integrity. One thing to note as well is that it's probably good to get familiar with the IRS rules on expenses and depreciable assets, since there are a lot of moving pieces. And I'm wondering if this is going to be a major component of the CPA exam if we have anybody sitting for the CPA exam. Like eventually one day I will. I found this to be very interesting. It has piqued my opportunity to delve a little bit further into it as well. I hope you all enjoyed my presentation. My sources are as follows: Fundamentals of Taxation 2024 edition, as well as IRS Publication 946 of the year 2023. Thank you.